As you know, in 2016, the United Kingdom held a referendum on its membership of the European Union. The result, with a margin of 51.9% to 48.1%, was the UK should leave the EU. And this decision, commonly referred to as Brexit, has had a significant impact on the UK economy, society, and its relationships with other countries. One of the areas affected by Brexit is the regulation of company listings. The UK's Financial Conduct Authority, or FCA, is responsible for setting the listing rules which govern the process of companies being admitted to the London Stock Exchange, the LSE. Before Brexit, UK companies seeking to be listed on the LSE had to comply with the EU's Prospectus Directive. This meant that they had to provide investors with a comprehensive prospectus containing detailed financial and other information about their own company. Following Brexit, the UK has replaced the Prospectus Directive with its own regime. The new regime is broadly similar to the EU's, but there are some key differences. For example, UK companies are now subject to a lighter touch regime for prospectuses than they were under EU law. And the UK's departure from the EU has also had an impact on the regulatory framework for cross-border listings. UK companies can no longer access the single market through a single prospectus as they were able to before. This has led to an increase in the cost and complexity of cross-border listings. The overall impact of Brexit on company listing rules is complex and multifaceted, and there are really some big changes here. As I said, the UK has replaced the EU's Prospectus Directive with its own regime, and UK companies are now subject to a lighter touch regime for prospectuses than they were under the EU law in the UK. But the UK companies can no longer access the single market through a single prospectus, as I said. And these changes have led to an increase in the cost and complexity of cross-border listings, and the long-term impact of Brexit on company listing rules is still quite uncertain. The UK has also introduced its own regime for takeovers and mergers. The UK is currently in the process of negotiating new trading arrangements with the EU, and these arrangements could have further impact on company listing rules. And I don't mean the TCA that's there, but they are still negotiating. The UK government has said that it wants to make the UK a more attractive place for businesses to list. It has proposed a number of reforms to the listing rules, including allowing companies to disclose any proposed significant corporate transaction rather than the current mandatory vote of shareholders. Brexit has had a significant impact on the regulation of company listings in the UK, as I said, and the UK has replaced the EU's directive with its own, and even for takeovers and mergers. And the long-term impact of Brexit on the listing rules on that part as well are still not known to anyone. But they remain an important area of focus for UK businesses and regulators. And now Britain's markets watchdog has proposed a single entry point to simplify and speed up company listings in the biggest shake-up of its kind in 3 decades, to help London compete better with New York, as well as European Union centres in the wake of Brexit. Britain accounted for only 5% of IPOs globally between 2015 and 2020, with the number of listings down by about 40% from a peak in 2008. The government failed to persuade UK chip designer ARM to list in London rather than New York, for example. As expected, the Financial Conduct Authority, the FCA, said it proposes merging the premium listing on the London Stock Exchange, which has tougher rules, with a less onerous standard listing to meet one set of criteria under the banner of a commercial company listing. It largely mirrors a discussion paper from last year that triggered some concern about a return to light touch regulation. We are working to strengthen the attractiveness of UK capital markets and supporting UK competitiveness and growth. That was said by Sarah Pritchett, FCA Executive Director for Markets and International, and that comes from a statement. It was important that others consider what they in turn can do to make sure the UK remains an attractive place for companies to raise capital given listing rules were not the primary reason for choosing a location, as the FCA said. It has proposed relying more on disclosures by companies rather than specific rules, thereby transferring more of the risk from an IPO to investors. Companies would disclose any proposed significant corporate transaction rather than the current mandatory vote of shareholders, which can be time-consuming in a fast-moving competitive bid. However, shareholder approval of a reverse takeover or a delisting would remain, and there would need to be written relationship agreements with controlling shareholders. Britain is keen to shake up listings and other financial rules to boost growth at a time when private money is needed to help the country invest to meet net zero targets. They say the UK is Europe's leading hub for investment, but it's a competitive world and we are by no means complacent. That was said by Britain's Financial Services Minister Bim Afolami. The EU is already approving a law to help attract more listing on the union stock markets. The FCA has cautioned that easing rules must be accompanied by a change in investor understanding and attitude toward risk. The proposals could entail an increased possibility of failures, but the changes set out would better reflect the risk appetite the economy needs to achieve growth, is what the FCA said. UK Finance, a banking industry body, said the proposals strike the right balance between managing risk and encouraging growth that will help significantly in attracting more listings. The 400 pages of detailed proposals are being put out to public consultation until March, with final rules coming into effect in the second half of 2024. The FCA has also confirmed new rules for bond market consolidated tape or real-time feed of transaction prices to help investors spot the best deals. The proposal will help investors hold their brokers accountable, which will improve the competition for their services and enable market participants to manage risk and maintain market stability, as the FCA said, adding it would outline its next steps for a stock price tape next year. The EU has approved a law to regulate stock, bond and derivatives tapes. The overall negative impact of Brexit on the UK is indeed a complex and multifaceted issue that is still being debated. However, there is a growing consensus among economists that Brexit has had a negative impact on the UK economy. The UK's imports from the EU, for example, have fallen significantly since Brexit, which has increased the cost of goods for businesses and consumers. This is due to the introduction of new trade barriers and the depreciation of the pound sterling, which has made imports more expensive. And the UK's exports to the EU have also fallen since Brexit, which has hurt businesses that rely on exports to the EU market. And this is due to the same trade barriers and currency depreciation that have affected imports, not to forget the cost of living. Businesses have been less likely to invest in the UK since Brexit, which is a sign of investor uncertainty about the UK's economic outlook. This investment shortfall has hurt the UK's productivity growth and job creation. The UK has also lost some of its talent pool due to Brexit, as some EU citizens who were living and working in the UK have returned to their home countries. And this has made it more difficult for UK businesses to attract and retain skilled workers. And Brexit has led to labour shortages in some sectors of the UK economy, such as agriculture, hospitality and healthcare. And this is due to a combination of factors, including the loss of EU workers and the UK's ageing population. Labour shortages have led to increased wages in some sectors, which has helped to offset some of the negative effects of Brexit on businesses. However, it has also contributed to higher inflation. The UK government has lost some tax revenue from EU businesses since Brexit, as these businesses have shifted some of their operations to other EU countries. And this loss of tax revenue has put pressure on the government's budget deficit. The UK government has also had to increase spending on border checks and other Brexit-related costs, which has further strain on the budget. The overall impact of Brexit on the UK economy is still being debated. Some economists believe that the negative effect of Brexit will be temporary, while others believe that they will be long-lasting. The UK government has estimated that Brexit will cost the UK economy 4% of GDP over the long term. It is of course important to note that the impact of Brexit has been uneven across the UK. Some regions, such as Northern Ireland and Scotland, have been more affected by Brexit than others, just in different directions. The UK government is pledged to support these regions, but it is unclear how effective these measures will be. And in conclusion, the overall negative impact of Brexit on the UK is a complex and multifaceted issue. While some of the negative effects of Brexit may be temporary, others are likely to be long-lasting. The UK government will need to take steps to mitigate these negative effects and to support those who have been most affected. The EU does that. And if you want to know more, the next video is right here in the end screen. I'll see you there. I'll be back.